Hi, David Moore with Equity Advantage, and I'm here speaking with Robert Smith of Peregrine Private Capital today, and we're talking all things DST. Thank you for tolerating my questions.
Thank you for having me, David. It's always an honor.
My pleasure. Good entertainment. So hopefully we're giving you some good ideas. Here's one for you. So I like to, if I walk into a commercial brokerage and I start talking about Section 121, the universal exclusion, I usually am meted with a whole rolling of eyes. And it's like, well, we don't work on houses. Why does this impact us? And I have to explain to them. I say, if they've got investors that have lots of real estate, they probably have an investor that's got a big house. And if we look at last year, we had a big fight on our hands preserving 1031, and one of the proposals was to cap your annual ability to defer any more than $500,000. And I had a hard time coming up why $500,000. And I think the only reason I can see is that the old Section 121, the universal exclusion for home sale, gives a married couple a $500,000 exclusion on gain. Well, when did Section 121 get put into place?
Probably when Bernie Sanders and his wife went on a honeymoon in Moscow.
Yeah.
Okay.
So 1997, Section 121 came into place, replacing Section 1034. And that gives an individual $250,000 exclusion on gain on the sale of their home. A married couple gets $500,000. So if we look at anywhere on the West Coast, for example, does $500,000 in gain cover much?
No.
Probably not, right? So, I mean, we've got right now inner downtown, and we're speaking with you from Portland, Oregon. So if we look at properties downtown Portland, even the biggest little tear down downtown's $500,000 today. And so if we look at that 250 or 500, it really does very little for people. So what I'm trying to get people to understand is, 1031 applies to what something is at time of disposition. Section 121 applies to anything that fits a 2 out of 5. So Section 121, universal exclusion, you can use that on any property you've lived in for 2 out of the preceding 5 years, treated as your primary residence. So you could move out of your home. If you've got gains well in excess of the 250 or 500, you might think I'm trapped, I'm going to have to pay that. That's not true. If they're patient, they could move out of the home, season it as an investment property, and then as long as they sell it within 3 years of moving out, you're still entitled to the 250 or 500. You can 1031 the overage. So I would put out there that a DST is a tremendous place to throw that excess money, right? I mean, wouldn't that be a great solution? Even if somebody's not familiar with investment real estate at all, they have the ability to invest money with you and put it into something that's should work out pretty well.
That's an outstanding observation on your part, David, and it's not something actually I've heard anyone else in the industry articulate, and it elides very well with the conversations we've previously had on the price of housing. I mean, housing is in many markets now prohibitively expensive, and honestly, because historically leveraged real estate has been a great inflation hedge, even with interest rates going up, we don't think it's going to take a lot of wind out of the housing market, and so you'll probably continue to see prices escalate, particularly in constrained environments like we have here in Portland, the California Bay Area, places like that. And most people, as you just mentioned, think, well, I've just got to bite the bullet and pay that. And if you're patient, as you just said, and are planning a major lifestyle change, you can actually step around that by doing just what you said. And that's something very, very, very worthwhile considering, because you do, even though you may not be or have much background in property management, DST gives you the opportunity to avoid that tax liability and put that money to work for you in income-producing real estate from which you don't have to shoulder any responsibility. So I think that's an excellent observation on your part again, and I haven't heard anyone in the industry talk about that. And with continuing escalation in housing prices, I think it's a very, very important thing to think about now.
We had, this was probably 20 plus, probably 20 years ago now, we had a client, Los Gatos, California property. You know what those cost, right? So they had a $3 million gain, and their lawyers sent them to us and said, hey, can you help these people? And I told them move out of the house. So they went from $1 million tax hit to zero. I tell the story that they bought 24 properties, closed them all inside the 45-day ID period. Because why? Because the ID rules, they couldn't work the 3-property rule, obviously buying 24. The 24 exceeded 200% of the relinquished property's value, so they were stuck at that 95% rule. She was a CPA. Last thing she wanted is to have a single sale fail, blow up the whole transaction. So she literally got them all closed inside the 45 days. Well, if she were looking at DST stuff, wouldn't be very hard, right? I mean, diversify anywhere into different assets geographically and asset types, all with the one transaction.
You just hit the nail on the head when you mentioned diversification. Historically, it's been very, very difficult to create diversification, whether it's geographic or functional, on your own. Mm-hmm. As you just mentioned, this woman who had to move heaven and earth to get all these individual transactions closed in a 45-day period of time. DST eliminates that, and it not only gives you, and now, as we mentioned previously, not only are individual DST programs diversified internally with multiple properties, but it's all you can pretty much slice and dice DST whichever way you want, so you can diversify functionally as well.
Yeah.
So it really is a great tool, particularly given how fully priced most assets are. We think your best protection against overpaying for a single asset is diversifying over multiple assets in multiple locations. And with DST, you can do that better, more easily than you can possibly do yourself. So yeah, I think it's a very, very, very valuable tool that way.
So I want to stress, if you type in, you could probably search 1031 into a primary residence. People ask that question all the time. They think, gee, I'm going to exchange out of this investment property, go buy a place at the beach, hold it maybe a year or so, whatever they and their tax counsel feels a reasonable period. Then they move into it and they're thinking, hey, I'm going to be able to take the exclusion, get rid of all my gain. Well, that doesn't work. I want to put it out there straight up. It does not work anymore. All right. Number one, you got a 5-year required hold. And number two, you got the Housing Assistance Tax Act of 2008 to deal with, which is really going to restrict what you're able to do. But it's still something, if you want to go buy a property, exchange into it, hold it for a period, move into it, it still works. But don't do it thinking I'm going to get rid of the tax. But I really don't hear people talking about what we've just been discussing. I think the real opportunity for people to keep their money there, especially in high dollar states, the whole West Coast, for example, you're in a situation where that 250 or 500 is woefully short of going to cover your situation. So I think you really got to look at a situation where it's like, okay, hey, it appears I'm selling my home. Do I want it to be my home? And if I treat it and convert it, now I'm not selling my home. I sell it within 3 years of moving out. I'm still entitled to 250 or 500, and then you're just 1031ing the overage into whatever it might be. And I would say, for my friends, the ones I talked about selling their houses, buying the camper and traveling, that's a perfect solution. Go buy some DSTs and I said DSTs for diversification purposes. I just think it's a great solution. So we're going to come back and talk a little bit more on diversification issues and some other topics. But David Moore, Equity Advantage, and Robert Smith of Peregrine Private Capital, where can they find you?
503-241-4949 or rs@peregrineprivatecapital.com.
Thank you. Be right back.